Fed can cut interest rates, and the stock market can still crash. Wait, isn't cutting rates supposed to be good? Not always. Let's talk about it. Everybody keeps asking the same question. What's the Federal Reserve going to do next? Raise rates, cut rates, pause, and then people immediately jump to one conclusion. Stocks are going up, or stocks are going down. Honestly, that's way too simplistic, because here's what most people miss. The Fed's decision isn't the whole story. The reason behind the decision, that's what actually matters. Let's start with rate hikes. When the Federal Reserve raises interest rates, it's making money more expensive. Loans cost more, mortgages cost more, business borrowing becomes more expensive, people spend less, companies invest less, and suddenly cash and bonds start looking a lot more attractive than stocks. That's one reason why growth stocks usually struggle when rates rise. We saw that happen in 2022 when the Fed launched one of the fastest rate hiking cycles in decades. Stocks fell, bonds fell, crypto got crushed. But here's where it gets interesting. Most people think the Fed is still raising rates. Stay away from stocks. History says not necessarily. The market doesn't wait for good news. It starts pricing the future long before the headlines catch up. Capital Group studied 4 completed Fed hiking cycles between 1995 and 2018. On average, the S&P 500 gained about 16% during the year after the final rate hike. And here's the crazy part. The first rate cut didn't happen until roughly 10 months later, meaning investors who waited for the first cut often missed a big part of the recovery. Now let's flip the script. Everyone hears the Fed is cutting rates, and they immediately celebrate cheaper borrowing, more liquidity, higher stock prices. Sounds bullish, right? Well, not always. Sometimes the Fed cuts rates because inflation is finally under control. That's usually a healthy sign. But sometimes the Fed cuts because something has already gone wrong. Companies are laying people off. Banks are under pressure. Credit markets are freezing. The economy is slowing down. In those situations, the first rate cut isn't the hero. It's the smoke alarm. The CFA Institute found that only 2 out of 10 historical rate cut cycles avoided a recession. In most cases, the stock market had already peaked before the Fed even started cutting. That's why asking, are rate cuts bullish, is actually the wrong question. The better question is, why is the Fed cutting in the first place? Now here's the part most investors should remember. The Federal Reserve controls the price of short-term money. It does not control innovation. It does not control entrepreneurship. It does not control productivity. It does not control great companies from building better products and making more money. That's why, over the long run, the market has survived inflation, wars, recessions, banking crises, the dot-com crash, the financial crisis, COVID, and even the fastest rate hikes in decades. Markets don't move higher because nothing bad happens. They move higher because great businesses continue creating value. So here's the takeaway. Stop asking, will the Fed raise or cut rates? Start asking, why is the Fed making that decision? Because context beats headlines every single time. This is educational content, not financial advice. Don't sue me, bro.